Okay, let's just dive right in. I want you to imagine an investment where you know exactly what you're going to get back and when. Sounds pretty predictable, right? And yet, it's a world where traders bet and make millions. How does that even work? Well, welcome to the world of fixed income.
I mean, really think about that for a second. An investment where you know the exact date you get paid and the exact amount of money that's going to hit your account. No guesswork, no surprises. And yet, this is one of the biggest, most active financial markets on the entire planet. So how is that possible? Let's break it down.
All right, let's just forget all the complicated financial jargon for a minute. We're going to strip this down to its absolute basics so it makes perfect sense. Let's just use a super simple example. Imagine you lend a friend 1,000 rupees. That's it. This one, simple action, is basically the blueprint for the entire fixed income market.
So your friend makes a deal with you. He says, look, I'll give you 50 rupees every single year for 5 years. And then at the very end of those 5 years, I'll give you your original 1,000 rupees back. And just like that, you've basically created a bond. That's it. This is the entire bond market in a nutshell.
So when we say fixed income, what we're really talking about is lending money. It could be to a government, could be to a big company, and in exchange for that loan, you get two things. Those regular, predictable payments, which in the finance world we call interest or a coupon. And then, at the very end, you get your original money back. We call that the principal.
Okay, and this is where things get really interesting. This is a huge mindset shift. See, most people look at a bond and think of it as just, well, a financial product, kind of like a fixed deposit. But a professional trader, they see something totally different. They see a machine that's programmed to generate a stream of future cash flows. You're not just buying a thing, you're buying a guaranteed series of future payments.
So, up to now, it all seems pretty straightforward, right? But this is where the action really begins, because there is one golden rule that governs this entire universe, and it changes everything.
Okay, so picture this. You've got your bond, and it's paying you a nice, steady 50 rupees every year. Life is good. But then, all of a sudden, brand new bonds hit the market, and for the exact same price, they're paying out 80 rupees a year.
So let's just put them side by side. Your old bond is paying 50 rupees a year. The shiny new one on the market, 80 rupees a year.
So, be honest. If you were going to buy one today, which one would you choose? It's a no-brainer, right? You'd go for the 80 rupee one. So, what does that mean for your old 50 rupee bond? All of a sudden, nobody wants it anymore. It's just less valuable.
And that right there perfectly explains the golden rule. Bond prices and their yields move in opposite directions. It's like a seesaw. When market interest rates, what we call yields, go up, the price of your older, existing bond has to go down. Why? Because its price has to drop to a point where its return becomes competitive with the new bonds. If you only remember one thing from this entire explanation, let it be this. It is the absolute core of bond trading.
So who are all these people and institutions borrowing all this cash? And what in the world are they doing with it? Let's zoom out for a second and see who the big players are.
Well, governments need to borrow to build stuff we all use. Think highways, schools, hospitals. Big companies borrow to build new factories or launch new products, which, creates jobs. And banks are constantly borrowing just to manage their day-to-day cash. So seriously, when you buy a government bond, you are literally helping to fund the country's growth.
And this market has a few different flavors. You've got your government bonds, often called G-Secs or treasuries, which are seen as super safe. Then there are corporate bonds, which usually offer a little more interest because they come with a bit more risk. And then you have short-term stuff like T-bills, which are for borrowing that's less than a year.
Okay, now let's get back into the mind of a trader. Because where a normal person sees a safe, predictable investment, a trader sees a gigantic playing field of opportunity.
All right, get ready for a fact that surprises almost everyone. If I asked you what the biggest financial market in the world is, you'd probably say stocks, right? Well, you'd be wrong. The global bond market is way, way bigger than the entire stock market combined. This is not some sleepy little side market. This is the main event.
And because this market is so unbelievably massive, even the tiniest little change, I'm talking a minuscule 0.1% move in interest rates, can create gigantic wins or devastating losses for traders. It's a game of incredible scale.
So this slide just nails the difference in thinking. A regular investor buys a bond and thinks, sweet, a guaranteed 7% return, I'll just sit back and collect. But a trader's asking a totally different question. They're asking, okay, If yields move just 20 basis points, and that's a tiny 0.2%, what does that do to my P&L? How much money do I make or lose? See, they're not playing to collect the interest, they're playing to profit from the price changes caused by those tiny interest rate moves.
Now at this point you might be thinking, this is all pretty interesting, but I'm not a bond trader, so why should I care? Well, believe it or not, this stuff affects you, me, and everyone else in some really significant ways every single day.
Think about it. The interest rates that are set in the bond market, they directly impact the EMI on your home loan. They mess with the valuations of the stock market. They decide how easily companies can borrow money to expand and hire people. They even affect the strength of our currency. It's all connected.
So from now on, whenever you hear on the news, the central bank is raising interest rates, I want you to think beyond just, oh, my loans will get more expensive. What's really happening under the hood is that existing bond prices are falling, and the entire global financial system, like a giant machine, is recalibrating itself based on that new reality.
And that brings us to the real heart of it all. Fixed income is kind of a misleading name. It's not really about fixed returns. It's about the very complex, very dynamic business of figuring out what future money is worth today in a world that is always, always changing.
So now you get the what. You understand what fixed income is. But that, of course, just opens up the next big question. The how. How do traders actually calculate the price of all that future cash? How do they put a precise number on it today? Well, that's where the real game begins.